Okay. Yeah. Let me share this with you, what I'm going to discuss. Now, there are three situations in which we need to look at. Suppose we look at a situation where, see, normally intercompany shares is not allowed. Therefore, you have to be careful. Now, what situation we are looking at, let me just tell you. Let me read it, then you will see. When one transfer company is A, holding shares in another transfer company B. So both these merge into and become C. So let us see what they are saying. Where a transfer company holds shares in another transfer company, such intercompany shares may or may not be taken over the transfer company, which is in this case C. Suppose A and B are amalgamated to form C, and 1/4 of the shares of B are held by A as investment. If investment in shares as per books of A are not taken over by C, no special treatment is required in the books of C. Or in the case of B Limited, entries over will be required in the books of A Limited, where either the following alternates may be done. So let me just put up a sheet so that you understand. This is A, B, this is C. Now, who is holding what? Let us go back again, just read it. A and B are to form C. 1/4 of B are held by A. 1/4, therefore, so many shares are there. 1/4 shareholders, these are the shareholders. 3/4 outsiders. Out of the total shareholders of B, 3/4 are outsiders. 1/4 is who? A. So in the books of A, there is investment in B. Investment in B. Now, what is the situation? Both are being taken over by C. And when C is taking over A, this investment is not being taken over by C. Not being taken over by C. So in the books of C, this will be remaining. You will be transferring to realization account. As I told you, all the assets has to be transferred. The investment will be closed here. But there will be no purchase consideration received from C because it is not being taken over by C. Instead, what will happen when C is settling B? When C is settling B, he will be giving the whatever the proceeds to B, to whom? Shareholders of B. So shareholders of B are who? These people. These are the share. These are the shareholders of B. So when C is settling the shareholders of B, these are the shareholders of B. In that shareholders list, A is one of them. A is one of them. He is getting money. For what? For the investment that he has been holding. So what he will do, he will get the money from C as a shareholder of B, bring the money as if realization towards the investment and credit it to his realization account. For example, if C is giving cash for settlement, that cash will be brought here and credited to realization because it is against this investments. So when you do realization of whatever is the money that is being made will be credited. Maybe it will come as, suppose it's an shares in C Limited, then that will be brought in as a shares in C Limited will be debited and this account will be credited. Realization will be credited. If it is cash, cash will be debited, this account will be credited. What? Why? because it is against the investment held by B in the books of investment held in the books of A as investment in B. So when B is getting settled, one of the shareholders is A, who is holding 1/4. So he will also get 1/4 of the settlement. That money he will bring and keep it. There is no entry here, no entry, no entry, no entry for this investment, no entry here also, because that is like any other shareholder, they are settling it. Here also he doesn't bother. Only here we have to be careful. Whatever money is being distributed to A as a shareholder of B, that money you will bring and give, put it in the realization account. Okay. Now let us go back. So I'm again reading it so that you understand. If the investment shares as per A Limited are not taken over by C, no special treatment is in the book of book C. Or in the case of B, the entries over will be required in the books of A, where as follows: investment account representing B will be transferred to realization along with other assets since A holds the shares of B Limited. Cash shares will be received from the liquidator of B as the shareholders of the company. This will be credited to the realization account. Not to if you are not transferring realization, net only profit loss will come. But we are following this first method, so you should go by that, not the second method. Now, what is the next situation? Transferor company. There is no three companies, only one company. Suppose this is A. Transferor company holding shares in transferee company. In our case, earlier case it is C. There is no B. In that case, what happens? So let me draw the idea here. This is A and this is C. A is holding shares in C. That means here investment account in C Limited. C Limited. Transferor company. This is a transferor company holding shares in C. This is a transferee company. What is the transferee company? C is taking over A. That is the scenario we're looking at. In that case, what happens? A is already holding shares in C Limited. So when purchase consideration is calculated, to the extent of the shares in this thing will not be considered and will be reduced to that extent because he is already holding those shares. So this will not be considered as part of the purchase consideration. You calculate purchase consideration, but you will be reducing this amount and only the net amount will be taken as purchase consideration because he is already holding the shares. So when the number of shares being transferred, that much number of shares will be transferred less because already A is holding as investment in C Limited. Only the balance will be transferred to A and ultimately it will be settled. Investment of transferor company representing shares in the transferee company cannot be taken over the transferee company as the company cannot purchase its own shares unless certain conditions are satisfied. Purchase consideration. The transferor company is to issue certain number of shares to each shareholder. The transferor company has purchase consideration. Then the number of new shares to be issued will be calculated as under. Find out the total number as usual would have been issued had there been no shares of the transferor company held by the transferee company held in transfer, as if nothing is being held. Find out the total number of shares so obtained, deduct the number of shares already held by A to be reissued. That only, that means whatever is being held, suppose 1000 to be issued, already is issuing 200, only 800 will be issued now. Purchase consideration will be calculated in the new shares, that is on 800 only. If purchase consideration is to be satisfied by issue of shares on the basis of net worth takeover, investment account representing in the transferee company should be excluded in the calculating net assets. This is in the nature of purchase if you are doing, in the nature of, payment basis purchase consideration. If you are doing takeover, don't consider the investment and calculate the purchase consideration. While closing the books of the transferor company, the investment in representing the shares already held Transfer company, that is when you are closing the books of A, the investment already held in the transferee company should be transferred to realization. The new shares received at purchase consideration will be debited by this investment account. Besides, should not be transferred to the realization, because that will close the account. You should not, because this is going to be distributed to the shareholders. That means all 200 should be held as it is, should not be transferred to realization. Now again you are getting 800. That 800 plus 200 put together will be given to the shareholders. So again I'm reading, while closing the books of the transfer company, that is A, the investment account representing shares already held in the transfer company should not be transferred to realization. The new shares received, that is 800 as purchase consideration, will be debited to this investment account. That means already you are having 200, 800 will be added to the same account to make it 1000, and 1000 will be given to the shareholders. Besides, the existing shares may be brought to the same value at which the new shares have been issued. Profit and loss account on such revaluation will be transferred to shareholders account or realization account. So this may be in two values, therefore this will be brought to the value of this. Okay, now what you do is,